Ray Dalio, you have to allocate capital regardless of the environment as the backdrop. And you've been doing that for years very effectively. In fact, even just in 2018, you were up almost 15% in the face of all of what we're talking about, increasing debt levels, global slowdown, and so many other things. Tell us how you see the backdrop and how you do allocate capital in this environment.
Well, let's say the backdrop. Maybe I start with a template. I think over a period of time, there's productivity, and the growth rate of productivity is the most important thing. You learn more, you invent more, you become more efficient, and that rises. Then we have cycles around that. We have a normal business cycle, short-term debt cycle, and then there is a longer-term debt cycle, which has to do with the capacity of leveraging up being limited when you approach zero interest rates or limitations in terms of the effectiveness of quantitative easing. So that framework is what I use when I'm looking at China, when I'm looking at any country. I think we make bigger picture. I think we are in the later stages of the short-term debt cycle, meaning maybe we're in the seventh or eighth inning of that, and that there was an inappropriate, mistaken desire to tighten monetary policy at a level that was faster than the capital markets could handle. And as a result, we had a correction. We had 70 basis points change in rates. We had an important change in Fed policy regarding what the direction of Fed policy will be in that tightening. But we're in the later stages of the cycle when asset prices were fully priced and still are somewhat fully priced. I think the key question, like when we look at each country, when we look at China, look at Europe, look at the United States, we will be in a slowing economic environment. That growth rate will slow, and probably in a self-reinforcing process. I think, but the question really is whether monetary policy is denominated in one's own currency. These are all cycles. The cycle, like in China, I agree. It's one of those cycles people pay attention to, but they have the power. The debt is in their currency. They can handle that cycle. But there is a weakening there. There is a slowing, certainly a substandard growth rate in Europe, and in the United States, there will be a significant slowing in that particular period, which should warrant an easier monetary policy. The bigger issues, so these are the cycles, and then there's constraints of monetary policy for being able to deal with that. Then the bigger issues are really connected to politics and the economic policies associated with that. For example, when we cut corporate taxes, and we also made interest rates low enough that it was attractive to borrow to buy financial assets, particularly by companies having mergers and acquisitions, that caused a lot of growth in corporate debt. And that growth in corporate debt was used to finance those purchases, which supported the financial markets. So that is going to be less. So I think that probably next year, the slow up and then the beginning of thinking about politics and what that might affect economic policy beyond, something like the talk of the 70% income tax, for example, will play a greater role. So I think that's, if I'm covering the world, U.S., and we live in a world economy, U.S., Europe, China, all of those will experience a greater level of slowing, probably a greater level of disappointment. And I think there's a reasonable chance that by the end of that the monetary policy and fiscal policy will have to become easier relative to what is now discounted in the markets.